Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Two-year Treasury yields top 5% as Jerome Powell says the Fed won't hesitate to hike again if needed. Joe Manchin buys out. The West Virginia senator announces he won't seek re-election, a blow to the Democrats. And on the rocks, Diageo plunges as profit warnings abound. Swiss luxury giant Richemont also surprises with an earnings drop. A very good morning to you. If you want to understand the biggest one-day drop in a price of Diageo, there you go. This is the biggest one-day drop since 1997. I was learning how to drink tequila in 1997. Diageo are warning the first half of 2024 is going to be materially weaker. Latin America and the Caribbean are going to be under pressure. Get out there. Get yourself Johnny Walker, Guinness tequila. I bet you there's a few people out there that are looking at that stock and really in pain. Now, when it comes to the equity market this morning, we've managed to eke out the tiniest of gains, but there was a battering yesterday because the unreliable boyfriend, Powell, shattered the equity market dreams. That hope of 9 days of gains, gone. Twos ratcheted. Powell got stern about the need for possibly moving rates higher. Equity markets choked. He won't hesitate to raise rates further. Tesla dropped by 5.5%. You've got HSBC with a sell rating, an equivalent sell rating on that. Nasdaq is down by 1%. Stocks in Europe are down. Diageo is one of the drags there, but also Richemont. The rich aren't drinking expensive tequila and they're not buying expensive watches. That's not that expensive. But Richemont say that their sales dropped by 3%. Customers are feeling the pinch. Luxury demand is normalizing, according to Sanford Bernstein. Richemont simply joins the moderation club. A very good morning, Danny, from a moderate watch.
Manus, can I just say, I can't believe you started your market check with alcohol. When they say it's 5 o'clock somewhere, they don't mean 5 a.m. But, you know, it's good to get it. All right, I have a board for us of the convulsing of this Treasury market. It was a 1-2 punch. First, the 30-year yield jumps some 22 basis points after a poor auction. And then the 2-year yield joins the pain after Powell's testimony. All within this, there were also concerns of the world's largest bank, their U.S. branch of ICBC, receiving a hack, fears that they couldn't complete some Treasury trades and putting more strain on the liquidity of the bond market. We remain above 5% for the front end of the curve. Let me walk you through where we are today. So we're holding on to the losses of yesterday in the U.S. yield curve. Meanwhile, the U.K. also selling off higher by about 6 basis points this morning. We got some data. The U.K. flatlines for the quarter. The expectation was a recession, so we narrowly avoid that. But Hugh Pill says that they're more or less done. That policy is restrictive enough. We also heard from UATA yesterday. We've had so much central bank speak this week, Manus. UATA speaking at an FT conference saying that it is easier if inflation overshoots. In other words, considering the lack of inflation in Japan, he is nervous to hike too soon. It's easier to fix the issue of inflation being too high than inflation being too low in Japan. So yen continues to weaken at 151. Now, Manus, on Powell yesterday, the question that we're going to debate is, was this a policy shift or a tone shift? Evercore ISI argues that it was more nuanced. The market doesn't do nuance, apparently, according to John Authors, but it was more nuanced. This was just a course correction from his more dovish policy speech. It wasn't necessarily saying, OK, we're going to hike in December.
Or was it that he just had to regrasp the narrative? The bond work had done their dirty work for them. We'd unpicked a lot of that. We'd gone almost louche on FCON. So I put it to you back that, you know, it was about trying to regrasp that narrative. But let's hear from Fed Chair Powell himself. He reinforced, Danny, as you say, policymakers are committed to ensuring interest rates are high enough to return inflation back to the goal of 2%. Now, he spoke at the IMF conference in Washington.
If it becomes appropriate to tighten policy further, we will not hesitate to do so. We will continue to move carefully, however, allowing us to address both the risk of being misled by a few good months of data and the risk of over-tightening.
Well, our next guest says Chair Powell's comments yesterday should be seen through the prism of loosening U.S. financial conditions as stocks and bonds have rallied. Is Powell indulging in a multi-trillion-dollar game of chicken with the market? I think so. A very good morning. That's the words of Simon French, not me. Who would I dare to have an opinion on the bond market? Simon French, do you think he's satisfied that he has regrasped the nettle? The bond market is doing his dirty, dirty work.
Well, that's his desire, and I think you were right in your introduction that the bond market, indeed broader capital markets, had been steadily loosening financial conditions over the last 10 days. And I think we should expect this as a regular theme over the next few months. As financial conditions wax and wane, agnostic of the policy stance, agnostic of what central banks choose to do with deposit rates, with their asset divestments, there will be a sense that as financial conditions, and they could go the other way, of course, they could over-tighten and we start to see a more dovish narrative. It'll be a dynamic game, and the challenge, if you like, for investors is to understand, and I think, trying to understand whether it's a fundamental policy shift or a change in tone to try and massage conditions is going to be the first-order challenge. The second-order challenge, of course, is much more for the Fed themselves, is can they retain credibility by just jawboning and not having a potential follow-through in terms of a policy response?
In their communication of tighter markets doing the work for us,
yep.
How long do markets actually need to stay tight to do the work? Because presumably, if you need that wealth effect to hit folks, if you need companies to run into issues when it comes to refinancing, it needs to be a while, surely, that they need to put up with higher bond yields and stocks selling off.
Yeah, well, what I took away from Powell's testimony is his officials don't know. And sometimes we have to acknowledge that we don't know what the transmission mechanism looks like, particularly your correct point, the negative wealth effect from some pullback in asset prices and what that does in terms of pass-through to consumption. That negative multiplier, we haven't had a lot of contemporary data on which to appraise that in similar economic circumstances. So we're guessing, and therefore to some extent what Mr. Powell is trying to do is buy himself time for the data to confirm or indeed to contradict some of their prior positions. So it's about buying the space for the data to come in rather than actually saying, this transmission mechanism has this many months, this many quarters, this many years before it becomes sufficiently contractionary for us to claim success on the fight against over-target inflation.
Right.
Simon, I mean, we've been waiting. It's been the best telegraphed slowdown, soft slowdown, hard land. It depends who you talk to, really. It has been the most telegraphed, talked about, but the data has not delivered, except I would say to you last Friday was a glimmer. There was a crack in the wall. But do you still think that we really lack a deep understanding of what helicopter money's ramifications were, the change in the working week and the change in demographics, and people, dare I say it, people my age going, you know what, I've had enough, I'm off to the beach?
It's a good choice. The one thing I would say around, one thing I'd say is that trying to disentangle US monetary policy from US fiscal policy, which of course have been running on very sort of counter agendas, is the real challenge here, because it could be that the impulse from tighter money, tighter financial conditions is running entirely to textbook, but what is not is running a 6-7% deficit as a percentage of GDP as far as the eye can see. And therefore, to understand the efficacy and the transmission mechanism of monetary policy, these things never happen in a vacuum. But I think what you saw in terms of tallying back the economics to some of the corporate results you broke on Diageo and Richemont, you are seeing globally, and this is not just a US story, some of that revenge spending, particularly high net worth individuals, high income demographics that had excess savings during the pandemic. You're certainly seeing that starting to revert. The question really there for much of the corporate sector exposed to that is whether there will be, and I hate the phrase soft landing, but I'm going to use it, whether there'll be a soft landing of demand, or whether we'll see undershooting and something of an air pocket of demand because of an overconsumption in the last couple of years.
See, man, it's okay for Simon to talk about alcohol because it's 10 a.m. here, so it's like a little bit more civil to be talking about.
Technically, it's 5 p.m. in Hong Kong. I'll have you know, when they did the marketing for this show originally, it was 5 a.m. in Hong Kong, 10 a.m. in London, and 5 p.m. in Hong Kong. Somebody trapped in an elevator with a caipirinha.
This is the reality of Bloomberg TV. It's a 24-hour channel, so someone's always drinking everywhere. But apparently not Diageo. And to your point, Simon, about that is it does seem to contradict some of the data. At first, we're saying consumers are still spending, but only on the top end. It's the lower-end consumers that aren't spending anymore. But here we have these results, not just Diageo, it's Richemont, it's Gucci's parent, it's all these different earnings. Why isn't that yet filtering through into the macro data?
Partly because there's still quite a lot of flux in the composition of spending, but also in terms of labour market indicators, and Manus talked about a slither of hope that the labour market, that lagged indicator, is starting to turn. But there is still actually quite a lot of misallocation of where labour exists across the developed world. Labour had been hoarded in areas where there were labour shortages, and that right-sizing of activity in the short term, actually, it's still quite beneficial for labour income. Labour income's potentially growing quite decent real terms click over the next 12 months. Even if the overall denominator, the workforce, may start to plateau, you're actually starting to see for the first time, as CPI comes down and wage awards remain relatively sticky, some proper real income growth, which should, if you like, hold pause to the Fed saying the battle is won on oversized inflation.
Let's just talk briefly about the UK, just to button it up. We've flatlined at home in the UK, so we've avoided an outright recession. But Hugh Pill, I mean, there's trouble at Mill, isn't there, in the Bank of England? Hugh Pill and Bailey, having established monetary policy in restrictive territory, it is not the case that we need to raise rates again. That's not what the governor is saying, is it?
No, it's not. I mean, I have some sympathy with the Hugh Pill camp on this one, which is in contrast for North American viewers who maybe not familiar with the nuances of how the Bank of England go around forecasting. They take the market curve and the market curve to condition their forecast, unlike the Fed with its dot plot. And if you take a market curve which is now showing interest rate cuts in the second half of 2024, I don't think it's tolerable not to talk about it. So Hugh Pill's prepared to talk about it. Andrew Bailey isn't prepared to talk about it.
Right.
Who do I think is taking the better approach? I think it's Hugh Pill.
Okay. Simon, unfortunately, that's all we have time for, but it means we can let you go enjoy a Johnny Walker, Guinness, or whatever your Diageo brand of choice is at the pub. Simon, thank you very much. Panmure Gordon's Simon French there. All right, let's get to some other stories that are trending on the terminal this morning. Turkey's president is calling for Israel to free detained Palestinians to secure the release of civilian hostages held by Hamas. Meanwhile, the U.S. says Israel agreed to pause fighting in parts of the northern Gaza Strip for 4 hours each day so people could flee. Manus.
John Kerry says COP28 is critical to keeping hopes alive on climate change. He spoke at the third and final day of the Bloomberg New Economy Forum in Singapore.
I think we're in a different world right now. We're seeing people be much more serious about this issue, much more prepared to make the investments we need to make, recognizing that if we don't, it's going to cost our citizens much more, not just in money, but in lives lost, regions dislocated, people in migration. The downsides of this are so serious, we've got to move faster.
And Macau casino stocks sank the most since March 2022 on disappointing earnings. Investors are concerned over crackdowns and weak consumption from China.
Coming up, the world's largest bank hit by a cyber attack, causing clients to reroute some of the Treasury trades, Danny.
And we'll speak to Edward Cole, Managing Director of Discretionary Investment at hedge fund Man GLG, about the Pavlovian urge to price in rate cuts on Bloomberg. This is Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Manus, the world's biggest bank, ICBC, had to trade through USB thumb drives after the U.S. unit was hit by a cyber attack. The hack left the Chinese bank unable to clear U.S. Treasury trades. Lockbit, a criminal gang with ties to Russia, is suspected of launching the ransomware attack. Joining us now is Francis Chan of Bloomberg Intelligence. Francis, I feel like they're just like a step away from having to do Treasury trades via carrier pigeons at this point. How is the cyber attack going to affect the bank?
Well, for ICBC itself, the impact should be pretty trivial. In fact, the treasury operations fees for this bank totaled only 476 million RMB during the first half. It's like 0.1% of the revenue during the period. So no business impact at all, I would say. But to the bank itself, its operations in the States, obviously, maybe clients are worrying about data leak. just like what happened to other victims of the cyber attack earlier this year. And for the bank, of course, reputational risk and also the similar risk may emerge in some of the Chinese banks.
I mean, just give me your first take. I mean, we'll talk about the expansion of risk, but your first take. I mean, moving a whole host of U.S. Treasury trades on a hugely volatile day in the bond market on a USB stick. I mean, that fills me with dread in terms of that's what they resorted to. But should the market be worried in any way? Lots of people are saying, look, this outage could inadvertently have pushed volatility higher.
Well, first of all, I believe there could be other participants in the U.S. Treasury markets, and I doubt if ICBC take the lead in that market, in fact, as one of the Chinese banks. About the volatility of the market, U.S. Treasury market, there could be many other factors. I'm not the best person to make a comment on that. Based on just what happened and what we have seen, per the announcement of ICBC, I believe the impact, at least to the banks, have been pretty much controlled. And the Ministry of State Security of China has been digging deeper into the issue and see if there will be any spillover impact to other Chinese banks.
Francis, thank you very much. Certainly one for the history books, an outage and a USB stick for Treasury trades. Francis Chan of Bloomberg Intelligence. 5 days that changed the narrative in the Treasury market. Here you go, Danny. 30-year government bonds over the past 5 days. Yields soared yesterday by 22 basis points. The auction, as you know, $24 billion worth of an auction. It was rich, it was expensive. So did the bond market get a touch of indigestion that people have talked to us about? Danny?
Manus, I gotta say, I feel like every week is a week that changes the narrative for this bond market.
I know, but we have to button up Friday, so we've got to go with this week's narrative.
No, but I think it's true, right? This is a week where the narrative changed because it keeps changing. This is the thing that's hard to wrap your head around, and it's having an impact on global bonds. Manus, let me just quickly run through that. Aussie also feeling pressure from what happened yesterday in the U.S. bond market. And we talked about this with Simon French, the UK averting a recession. Hugh Pill talking about policy rates being restrictive enough. Too bad for him. Bonds selling off this morning. Selling off in Germany too. 10-year moves higher by a basis point. More to discuss on your luxury goods, your alcohol this morning on Bloomberg.
Inflation in Europe. In the case the index is going to be stable in Europe in October compared to the September level, we might see an inflation in Europe which is about 3.5%. So we will see what happens, but if that's the direction, I might expect that we are going to see the curve slowly flattening and more the short end coming down as opposed to the long end coming up, and that will be clearly, from an Allianz point of view, also from a PIMCO point of view, the best case scenario.
That was the Allianz CFO speaking a little bit earlier on Bloomberg. And this is as the firm reported third quarter earnings that beat with profits. And PIMCO, third straight quarter of inflows. Just looking at the bond inflows, Danny, $10 billion of inflows. And Julio just giving us his view on curve flatteners. There you go, $10 billion of inflows. Who said that the bond market wouldn't come back to life in 2024? Danny?
And who said active is dead? Manus, one of the other big European market movers, SBB. Okay, so this is the Swedish landlord. It's been under a lot of trouble. Sweden has its own idiosyncratic problems when it comes to the housing market. There's this fear that it spreads more broadly. Anyway, there's a new issue for them. They're facing demand for bond repayments on claims that they have breached. One of them is New York-based Fir Tree Partners, saying that, yes, you breached the covenant. SBB rejects the claim that it's in breach, Manus.
Now, favorite topic. It is 5 p.m. Well, it's 5:24 p.m. if you're in Hong Kong and you are probably somewhere in the Mandarin Oriental ordering yourself a beautiful glass of Casamigo tequila. Probably not. That's the reason why the stock's down 14%. Diageo absolutely brutally attacked this morning. They're going to have a materially weaker first half of 2024. But do you know what caught my eye, Danny? I mean, the whole booze sector is taking a hit on that. Remy Cointreau, it's in the upper echelons of the market. Pernod Ricard. It's because Latin America and the Caribbean are going to be under pressure. And I find that quite interesting relative to, let's say, talking about Europe or the Americas itself. So, you know what? George Clooney got away when he got $1 billion for his tequila brand, didn't he? A couple of years ago, he got out the door.
He did, and I have to say, I'm kind of embarrassed because this morning when you were like, oh, Diageo, they own Casamigos, I was like, no, surely Clooney still owns that. I stand corrected. As you say, he did sell it to them. Diageo owns kind of everything.
Did you just admit that you made a mistake? Did you just say?
I can admit my faults,
Did I just hear
Manus.
you say, I'm sorry,
fault.
Manus, I made a mistake? No. Do you? No.
In case you didn't hear it, I'm sorry, Manus, I made a mistake. Clooney did sell to Diageo. There you go. You cut that. You make this a clip, Manus. You can replay it. You can replay it to me whenever I am too stubborn to admit other mistakes.
I think on a slightly more serious note, I mean, this watch is not an expensive watch. Don't wear those anymore. But the point about it is, the rich. Well, there's a wonderful book that I read years ago. The rich don't pay. Well, the rich aren't spending a vast. You know, they're skimming back. They're feeling the impact. And the chairman at Richemont says they're not going to be able to raise prices much in the next couple of years. There you go, Danny. This is a triumphant moment for Bloomberg Brief. There'll be one day I'll have to apologise and eat mea culpa with you. Ed Cole joins us next, Managing Director for Discretionary Investments at Man. Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Two-year Treasury yields top 5%. Jerome Powell says the Fed won't hesitate to hike again if needed. Joe Manchin bows out. The West Virginia senator announces he won't seek re-election, a blow to Democrats. And on the rocks, Diageo plunges on profit warning, while Swiss luxury giant Richemont also slumps on surprise earnings drops. Just when you thought it was safe to buy bonds again, an auction, Anna J. Powell will have something else in mind for you. Also, when you thought it was safe for me to check markets, they disappear and magically come back. Here we are. The two-year yield, it is still above 5%. A huge jump yesterday after Jay Powell did in what Evercore called a tone correction, a little bit more hawkish. The 30-year was battered yesterday thanks to a weak auction. 10-year in the UK, this gilt market also facing losses, maybe a bit of follow-through from yesterday, but also UK GDP data for the quarter coming in. The prediction had been flat to a recession. It comes in flat, so we've avoided a recession, up about 7 basis points. And the yen weakens ever so slightly. But, man, it's at levels that are higher than last year when the MOF intervened. We're at 151. Ueda was speaking yesterday at an FT conference saying essentially it's easier if inflation overshoots to bring it back in versus than having inflation undershoot. I don't know. Try to tell that to Jay Powell. They've been having a tough time bringing inflation back in.
Yeah, they have. And that's why he tried to rearrest control of the narrative yesterday. And as Simon French said to us, how long will the jawboning last them in terms of keeping yields higher? The next second round effect is they're going to actually have to do something. Danny, lovely line from the Flow Show. You brought it to me during the break, and this is it. Cash is flowing in, set for a record year of inflows, 1.4 trillion this year, according to the Bank of America Flow Show. But you're right, it was the unreliable boyfriend, Jay Powell. He shattered the field of dreams of equity market rallies. We didn't manage to put the 9th straight day of gains, the longest run of gains since 2004. Bang! In the past 30 minutes, we've reverted to a sea of red on the equities. It's not malevolent. It's just dipping ever so slightly. Equity markets essentially got choked yesterday. Powell said, I won't hesitate to tighten further if needed. Jawboning needs action. That's what the market's probably saying. Tesla was down 5.5%. At the bottom of your screen, you had HSBC put out essentially a sell rating. Now, when it comes to the rest of the markets, NASDAQ down 0.2%. We talked about Diageo, but let's spend a little bit of time. Stock 600 down 1% now. These earnings are coming in, and they are brutal. Richemont, on the luxury watch styles, they're down 3%. Customers beginning to feel the pinch of inflation. But I love what Sanford Bernstein had to say, is that luxury has normalized, and that's what's happening at Richemont. They've joined the moderation club. So the rich, or the wealthy, or the aspirational wealthy, whichever you want to call them, Danny, they're not drinking their Casamigo, and they're not buying themselves new Panerais. Danny, good morning.
Good morning. Yeah, I guess everyone is trading down to the cheaper booze, the cheaper watches. But you got to imagine Chair Powell would be happy with this continued sell-off. We were talking with Simon French about this idea that they're playing a game of chicken with markets, that they're trying to bully them to get tighter financial conditions to do the work of the Fed.
But of course, there's a lovely piece from John Arthur's, shameless plug for our own material. Markets don't do nuances, do they? They go right up over the hill or they drop through the well. They don't deal with nuances. And to intellectualize is perhaps the worst case of all for a bond market. Danny.
Well, that's why people tune into Bloomberg Brief, because that's where you get your nuance. Manus, I had to throw in a plug for us. Anyway, I want to talk about another really interesting piece of commentary coming from Ed Cole of Man GLG. He weighed on the market reaction to the Fed, writing that markets have been obsessed throughout with identifying peaks in inflation and policy rates, but have generally ignored the level and the fact that time spent on a high plateau matters. Credit investors understand this. He called it the Pavlovian urge to price in cuts. Ed joins us now. Ed, I love that, the Pavlovian urge to price in cuts. Some of it kind of came undone yesterday. We pushed the cuts out by another month. Stocks sold off. But what will it really take to undo that urge of the market to be sanguine about cuts to come?
So, look, I think it's a fascinating moment. I think Manus just referred to Powell as the unreliable boyfriend.
Or the bond market, but maybe both are.
I think Powell's been the reliable boyfriend. He's told us consistently what he intends to do, and he carries on doing it. And each time we feel that there's some signal that things are normalising, that Pavlovian urge comes back in again. And it's extraordinary to me that, 18 months on from what looked to be the beginning of the hiking cycle, we're still here. I think what it's going to take to wash that out of markets' reaction function, possibly, is really the path towards a landing of some kind. If you think back to Jackson Hole in 2022, Powell told us that he was prepared to see weakness in employment and in businesses in order to bring inflation down. And we started to price hard landing. We've then taken that back out of pricing of markets. We never quite got there, I don't believe. But I think that's what it's going to take. It's going to take getting to a moment where we're actually in an earnings recession. We're actually in an environment where jobs numbers are weakening materially, and the Fed isn't reacting. It's the idea that the Fed put, which we've all got so used to, isn't there anymore.
Was not there, nor is there QT. I'm devastated, Ed. You've just destroyed my entire morning. Where I'm sort of going for the Panmure, J. Powell, one fell swoop from Ed, and it's over. But look, I think it is that the equity market had cloth ears in many ways. They didn't want to hear that there was a possibility of more hikes. I'm curious about the earnings. Danny and I spent a little bit of time on Richemont, a little bit of time on Caring, along with Diageo. There is a shift, and maybe this is the beginning of more concern around the higher-end consumer as well as the lower-end consumer. Your first take on some of those results this morning, because these stocks are getting pasted. Diageo, Richemont, all under pressure.
Yeah, I mean, look, typically we don't really talk about the individual names, and my role is look, I think the truth is that wherever you look in the consumer, almost, there are some pockets of resilience, there are some pockets of idiosyncratic resilience and sustained outperformance. And actually, that's a good thing, right? Because it's a stock picker's job, which is what we do to identify the good from the bad and the wheat from the chaff. But broadly speaking, at a macro level, we can now see that the lagged effects of higher rates and sustained higher inflation is starting to bite. Okay. That's what policymakers need to see. I'm a broken record on this. I've been incorrectly forecasting recession for as long as I can think of now. My children would probably say for as long as they've been alive. But I think that we're now starting to see in lots and lots of macro indicators and now micro indicators that the economy's slowing. Probably, if we just jump back a week, it seems like a long time ago, to the jobless numbers last week. One of the most interesting data sets that I look at in that is a combination of the average hourly earnings, the average hours worked, and the number of payrolls in the economy in the US. If you look at that in year-on-year terms, it's normalised all the way back to where it was pre-COVID. Right. So we have just positive real wages from payrolls in the US economy right now. We have the best data in the US, of course, but I would imagine it's similar in lots of places, and that's what's biting in the consumer.
Well, also, lucky for you, Ed, a broken clock has to be right eventually. So that's the good news. And in talking about this idea of a recession to come, it does feel like there's extreme nerves around small cap stocks. This idea in the US, a recession is coming, credit conditions will bite. If you look at the NASDAQ versus the Russell, this one actually snuck up on me. I didn't realize that the NASDAQ had actually hit a new high versus the Russell 2000, above the dot-com kind of levels. It seems like a tempting level to jump in and be a contrarian, but can you, if that recession still has yet to bite?
Well, so I guess underlying all of that is the question about the resilience of large cap stocks versus small cap stocks, which is undoubted, right? I mean, I think it's clear that the balance sheets, broadly speaking, of the tech giants are impeccable. I think, though, there's the Pavlovian component and all that again, which is what tempts me as a contrarian, which is that we've got used to mega cap tech having this perpetual runway of free growth, which they've had as a consequence of disintermediating existing players. And there's definitely evidence from last year, as the economy started to slow a bit after the COVID recovery, that actually many of these big cap stocks in the tech space have run out of inorganic growth. So I would question, if we have a recession or something like it, that we may well find that a lot of big cap tech is much more cyclical than we once thought.
Don't feel alone. I'm a perpetual bear, but there was one asset manager who came to visit me in Dubai. He said, "I've never met a wealthy pessimist." Here I am. I'm a journalist. Now, look, we were drawn to natural diversification of the 60-40 portfolio. I just got this in because Danny would have anyway, is now breaking down. So if it is breaking down and we go into this quasi-hard landing, soft landing, whatever kind of landing we're going to get next year that you're worried about, do I reallocate more to, if 60-40 is broken, how do I protect myself in 2024? Briefly.
Yeah, well, guess what? I work for a large alternative asset manager, and the answer is alternative assets, which is a surprise,
shocker.
Isn't it? I would say that, I mean, look, there's an asset class that doesn't help my employer, and that's cash. I think that has a real value. It has an overlooked value. We have to be clear that for the first time in a generation that cash yields something interesting, and that's useful for short-term periods if you're worried about corrections or downdrafts. It isn't useful over the long run. Ultimately, it's unlikely that cash is going to give you a return in excess of inflation. So you have to find things that diversify from traditional assets. You have to find things that give you a return above inflation. If you go back to the 70s, which was a period when 60-40 didn't work, it didn't really exist then, but if you go back and do it in time, which we've done, 60-40 didn't work. Ultimately, the positive correlation of those two asset classes compounded each other, so you had periods when it was amazing and periods where it was terrible. Right. But if you put alternatives into that mix, which we've done, you can put trend in, you can put equity long short, the diversification benefit is exceptional.
And there's a rule Manus and I always follow, and it's always be plugging your product. So you fit in very well here on Bloomberg Brief.
Ed's just selling dreams. Selling dreams, Ed. I love it. They're going to love you over at Panmure. They're going to go back to school and they go, go on, Ed, you got it out there.
He did well. He did well. Ed, thank you so much for joining us. Come back soon. Man Groove's Ed Cole there. All right, Manus, we've been talking about it all day, so let's bring in an expert on the luxury sector. Richemont reported an unexpected drop in earnings. Revenue from Swiss watches declined. That expert is Andrea Felstead of Bloomberg Opinion, who joins us now. Andrea, to what degree is this a one-off versus looking at some of these other poor results that luxury goods have faced and say, OK, this is endemic to the entire sector?
It is at the moment. What we're seeing across the sector is that things are slowing from the pandemic, when unexpectedly people spent their lockdown savings, their stimulus payments on Rolex watches, Gucci handbags, Cartier watches. That's now unwinding. Now, within that, you've got some better performers and some weaker performers. We had Hermes, Brunello Cucinelli selling to very wealthy people that have really outperformed. But where this is the most pertinent is the kind of the simply comfortable, the less wealthy, who are being pressured by inflation, higher interest rates, lack of stimulus payments, spending their savings on other things. And we're really seeing that across the luxury sector. Richemont, no different.
What did we, Andrea? Good to see you this morning. I'd love to see the stimulus check that you got for a Gucci handbag, but you know, I'll park that thought. I mean, what did we learn? Just take us into this. What did we learn about the far-fetched, the Net-a-Porter deal?
Well, this is the big question. Richemont has done this deal to sell a majority stake in Yoox Net-a-Porter to really get its losses off of its balance sheet, and its Farfetch is going to buy a stake in that. Now, the problem is Farfetch is really not performing well. One of the things that has really happened is online slowed, that aspirational customer. Farfetch is really at the nexus of that. Its shares have slumped. There are concerns about its short-term finances. The big question mark is, A, does that deal go ahead? Richemont seemed to indicate this morning that it would. But the bigger question is, does Richemont then have to come in and support Farfetch, or even take it over in a repeat of the deal it did with YNAP 5 years ago, which would go down very badly with shareholders?
Andrea, thank you very much for joining us this morning on The Luxury Goods. That's Andrea Felsted of Bloomberg Opinion. All right, coming up on the show, a closer look at the election coming up in 2024. A new poll from Bloomberg News and Morning Consult show who would win in a Trump-Biden rematch. We have the results next on Bloomberg.
It's your Friday edition of Bloomberg Brief. I'm Manus Cranny in New York. Danny Berger is in London. So the 2024 presidential election is less than a year away. And we have a new Bloomberg poll news, along with Morning Consult, suggesting difficulties. The balancing act for Biden in his re-election campaign. Joining us now is our Bloomberg White House and politics reporter, Gregory Corti. Good to see you, Greg, this morning. It's interesting. We spent a lot of the week talking about foreign policy. Obviously, the war between Israel and Hamas, funding for Ukraine. And it's become manifest in the polling, hasn't it? Americans are more focused on domestic policy over foreign policy. Good morning.
Good morning. Yes, and that's usually the case in American politics. It's always about the economy in good times and in bad times. But at some points, foreign affairs do intervene, and they take the president's attention away from the domestic issues. And that's what's happening now with President Joe Biden. He is occupied with this Israel-Hamas war, and he's trying to get a funding package through Congress, an emergency supplemental spending bill that would combine aid for Israel with aid for Ukraine, and also as a deal sweetener, try to include border security funding at the U.S.-Mexico border. And the problem with that approach is that while majorities of Americans support each of those aid proposals, it's not the same majority that supports all of those priorities. And so, particularly with Republican voters, there is a skepticism about Ukraine. And the domestic politics is intruding on the other side as well, that key parts of Biden's Democratic coalition are skeptical of contributing aid to Israel, and they're concerned about not doing enough to help civilians in Gaza.
When it comes to the candidates themselves, I know Manus is going to ask you about Joe Manchin in just a moment, but what happened with him does represent this threat of third-party candidates. I know you did some polling on Robert F. Kennedy Jr. and the potential for him to steal away votes from various swing states. What did the results show?
Yeah, it's very interesting. In our swing states poll, we show that former President Donald Trump is leading President Biden by 6 percentage points across the 7 swing states that we looked at. That's Arizona, Georgia, North Carolina, Pennsylvania, Michigan, Nevada, and Wisconsin. And that doesn't change when you add this third party, Robert F. Kennedy Jr., into the mix. He is not playing a spoiler right now. He's taking votes equally from Biden and from President Trump. And that's kind of surprising to us because Kennedy is a former Democrat who's now running as an independent, obviously very famous Democratic family, but also very popular with Republican voters because of his anti-vaccine views.
Yeah, it's interesting that, that seems to have won some voters rather than lost. Can we quickly square away Manchin is not running for re-election? What's the risk from that to Biden? Is it very, very real?
It is if he were to run as a third party or an independent candidate for president. Now, he hasn't announced that yet, but there is this no labels group that is getting lines on ballots across the country that would be a placeholder for a candidate, a centrist candidate, maybe somebody like Joe Manchin to come in next year, relatively late in the game. And that would be a different equation than Robert F. Kennedy for Biden, because Joe Manchin is a Democrat, or at least he has been for most of his career, and would likely take more votes from Biden than from Trump and could place forward.
Gregory, thank you so much for getting up early, for giving us the results of this poll. Bloomberg's Gregory Corti in Washington. Now, coming up, we're going to have a look at some of the market-moving events to watch throughout the day. But first, Manus, already have some moves in oil this morning. Yeah,
oil market sort of bouncing back. The bottom line, Pierre Andouin has a brilliant tweet. I'd encourage everybody to go and read it, which is, the draws, that tightening in the market just simply has not been delivered. And the oil market bounces by nearly 1% this morning on Brent. We're trading at $80.79. And on NYMEX crude, we're trading just at $76.45 is where we are. There's a quick snapshot across the assets, Danny. Prevarication in the equity market after a brutal sell-off yesterday. The dollar is flat.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manus Cranny in New York. Let's get you set up for your trading day with a look at what's ahead. ECB President Lagarde will be speaking at 7:30 a.m. Eastern Time, followed by Governing Council member Joachim Nagel at 10:20. In the U.S., Dallas Fed President Lori Logan speaks at 7:30 a.m. And then Atlanta Fed President Raphael Bostic at 9 a.m. Plus, we get the UMich consumer sentiment at 10 a.m. Looking ahead to the weekend, we're going to get a read on Chinese consumers with Singles Day coming up on Saturday. Manus, that UMich one, it's going to be really fascinating because last month's reading, it was the pinch of higher gasoline prices that had inflation expectations higher. And you also had that confidence reading lower. Will that have turned around this month, or are consumers still feeling the pinch?
Well, if you pick up from last Friday when we had the numbers come through on services and on jobs, etc., our guest this morning from Man Group, of course, a man saying, look, that was the small break for him in the not so such a soft landing. Still expect a lighter number on Michigan later today. That'll be out at 10 a.m. I'm just looking here. The October reading was still high, 2.2 to 2.6. So that's where you are on inflation expectations. Look, it's all about the bond market. I mean, there was a bit of an earthquake in yield moves yesterday. That auction was not exactly generous at the long end, 22 basis points higher. We continue higher this morning on 30-year paper. Danny.
You know what I just realized, Manus? I never said my fun fact of the day. Shame on me. It's that throughout the past decade, a tail on an auction has only been this bad one other time. Only one other time in the past decade have a 30-year auction gone so poorly, Manus.
Well, all I can say is, that's bad form, because you were supposed to be driving the bond bus for the whole week.
I know.
And the fact that you didn't share the fact of the day with me so that I could use it again and again and again. So, shame on you. But at least we didn't break anything. We just did our best.
Yeah, it's the least we can say, the least we can do for your folks. All right, enjoy your Friday and the rest of the weekend. This is Bloomberg.